I'm Andrew Murphy, Co-Chief Investment Officer at Winthrop Wealth, and welcome to our second quarter 2022 market review and outlook. This has been a difficult year for most major asset classes. The S&P 500 just posted its worst start to a calendar year since 1962, and the US Aggregate bond market had its worst start on record going back to inception of the index in 1976. In today's video, I'll discuss several key issues driving the markets, including inflation and the Fed tightening monetary policy. I'll also review performance in the equity and fixed income markets before discussing our outlook moving forward. At Winthrop Wealth, our total net worth approach to financial planning and investment management is designed to help our clients navigate through these challenging periods. Please contact us if you have any questions, and we look forward to speaking with you soon.
We'll start with the main issue driving markets this year, inflation. Many inflation readings are running in the mid to high single digits and are at the highest levels in decades. The Fed's preferred inflation measure, core PCE, came in at 4.7% in May. This is off the recent peak of 5.3% in February, but still well above the Fed's target of about 2%. The increase in inflation is driven by surging energy prices, supply chain bottlenecks, and strong consumer demand due to stimulus payments and a tight labor market. And while inflation was already elevated, both the Russia and Ukrainian war and China's COVID lockdowns are exacerbating the problem. We also want to mention that we are still trying to hedge the impact by holding low levels of cash in portfolios, avoiding long-term bonds, and tilting toward companies that can grow their cash flows, earnings, and dividends. The Fed has now firmly admitted that inflation is a problem and that they will tighten monetary policy to attempt to bring it under control. The Fed will act in two ways, by raising interest rates and shrinking the size of their balance sheet. After raising interest rates by 75 basis points at the June 15th meeting, the top end of the federal funds rate now stands at 1.75%. June was the first meeting since November of 1994 where the Fed raised interest rates by 75 basis points. And while the Fed has raised rates swiftly this year, they are likely only about halfway through the current tightening cycle. The FOMC's most recent summary of economic projections showed that the median participant expected the federal funds rate at 3.4% in 2022 and 3.8% in 2023. At the latest FOMC press conference, Fed Chair Powell estimated that a peak federal funds rate between 3.5% and 4% should be appropriate to bring inflation back down to the 2% target. The Fed's pivot to restrictive monetary policy this year has been jarring for financial markets and a key factor in the year-to-date declines. But any signs of disinflation, which would reduce the need for the Fed to further aggressively tighten monetary policy, would go a long way toward calming markets. Last year we cautioned that the stock market was coming off an unusual stretch of very strong returns with low volatility. Well, this year has been the exact opposite. High volatility and low returns, with the S&P falling by 16.1% in the second quarter, bringing the year-to-date decline to nearly 20%. The S&P also fell into the technical definition of a bear market, which is a decline of 20% on a closing basis, when the index fell by 23% from January 3rd through June 16th. This was the first bear market for the S&P 500 since the index fell by nearly 34% during the early part of the pandemic, from February 19th through March 23rd of 2020. Primary factors driving the decline in the stock market have been the same all year: increased inflation expectations, the Fed tightening monetary policy, the Russia-Ukrainian war, and COVID-induced shutdowns in China. Unfortunately, the bond market has also been weak. The Bloomberg Barclays US Aggregate Bond Index, or the AGG, which acts as a proxy for the investment-grade bond market, decreased by 4.7% in the quarter, and is now down by 10.4% for the year. Bond prices move inversely to interest rates, and the increase in the 10-year Treasury yield this year, from 1.51 to 3.01%, has caused a decline in the bond market. We hold fixed income to provide ballast, stability, and income to portfolios. And ballast means that ideally the fixed income holdings are increasing when equity markets are declining. bonds have not provided ballast for most of the year as interest rates have increased. But we do expect the negative correlation between stocks and bonds to return in the future once yields level out. On a brighter note, the bond market's yield to maturity, or the estimated rate of return an investor can expect from a bond if purchased today and assuming there are no defaults, has increased to 3.7%, which is the highest level in years. Our long-term outlook on the US equity market is more optimistic now than it was at the beginning of the year given the decline. Historically, the S&P 500 has produced an annualized return of about 9.4%. So we typically expect some reversion to the mean after periods of very strong or negative performance. And while the short term is highly uncertain, over the long term, we suspect this difficult economic environment has created a strong buying opportunity for investors willing to live with some near-term discomfort. We're telling clients to think in terms of years rather than days or months. At some point, the market will bottom and stocks will move higher. And we believe those who are able to either stay invested, rebalance, or add to their existing holdings will eventually be rewarded. Since we expect more volatility in the short term, we are sticking with our investment philosophy of maintaining a long-term viewpoint and a disciplined approach, while we continue to look for opportunities to tax loss harvest, reposition and rebalance portfolios, and selectively put money to work for clients that have recently made contributions to their accounts. During these difficult periods, our advice to clients is to do three things. First, keep the right mindset and avoid the impulse to market time, which is often an emotionally based decision and can be very value destructive to portfolios. Please see our client question titled, "Market Timing Does Not Work." Next, remember that your investments are backed by a financial plan, which is stress tested for different environments, including extreme volatility and market declines. The financial plan assumes that your portfolio will go through periods of weakness throughout your investment time horizon. And last, remember that we have a comprehensive and data-based investment process. We do ensure that at least 2 to 3 years of cash flow needs are covered while investing the rest of the assets in a globally diversified portfolio. And we will try to make lemonade out of lemons during these difficult periods by tax loss harvesting, rebalancing, repositioning, and putting new money to work.
Thank you for watching today's video, and please visit our website at winthropwealth.com to view the written version and to read our latest commentaries.